Issues in banking sector in India. Few issues and challenges in Indian banking sector are bad loans, bank fraud, cyber threats, capital adequacy, balance sheet management, non-performing assets, employee and technology. Bad loans. These are the loans which are not repaid back by the borrower. They are thus a loss for the bank. Bad loans are sources for buildup of stress levels in banking industry. India's pile of bad loans is bigger than the gross domestic products of at least 137 countries. These bad loans are squeezing banks' profitability and capital positions, threatening the health of some of India's biggest banks. Bank fraud. Another pressing concern for the banking regulator is the increased number of fraudulent transactions at Indian banks. Almost all corporate loan related fraud cases get seasoned for 2 to 3 years as NPAs before they are reported as fraud. In the last 5 years, the volume of the bank fraud has increased by 19.6% to 5,064 cases. Cyber threats. With the growing penetration of computers and smartphones and increasing access to the internet, cybercrime is becoming a greater threat. Indians are taking to digital channels for their banking needs. The RBI classifies bank fraud as transactions involving any cheating, negligence, misappropriation of funds, or forged documents. In the recent times, not only simple attacks using phishing, vishing, and social engineering, but also increasingly audacious attacks by organized gangs with or without backing by the state players have come to light. Capital adequacy. One way a bank tries to ensure it is protected from bad loans is by setting aside money as a provision. This money cannot be used for any other purposes, including lending. As a result, banks have lower capital available to use for its various operations. This capital adequacy ratio measures how much capital a bank has. When this falls, the bank has to borrow money or use depositors' money to lend. This money, however, is riskier and costlier than the bank's own capital. In the last few years, CRAR has declined steadily for Indian banks, especially for public sector banks. Moreover, banks are not able to raise money easily, especially public sector banks which have higher number of bad loans. If banks do not shore up their capital soon, some could fail to meet the minimum capital requirements set by the RBI. In such a case, they could face severe issues. Balance sheet management. In the past few years, many banks have tried to delay setting aside money as provisions. One reason for this is that a bank's chief executives have a short tenure, during which time they want to post higher net profits and cheer investors. Deferring provisioning is harmful in the long term. It reduces the bank's ability to withstand financial pressures. This is even more problematic considering the poor capital adequacy in Indian banks. Non-performing assets. NPAs have become a grave concern for the banking sector in a couple of years and impacted credit delivery of banks to a great extent. The share of gross NPAs in India could inch up to 10.2% by March 2018 from 9.6% in March 2017 according to the FSR. In September 2016, gross NPAs were at 9.2%. India's largest lender, State Bank of India, reported a massive 67% fall in consolidated net profit at 1259.59 crore rupees in the third quarter of the 2015-16 financial year, and classified loans worth 20692 crore rupees as having turned bad. Employee and technology. Public sector banks are seeing more employees retire these days. So younger employees are replacing the elder, more experienced employees. This, however, happens at junior levels. As a result, there would be a virtual vacuum at the middle and senior level. The absence of middle management could lead to adverse impact on banks' decision-making process, as this segment of officers play a critical role in translating the top management strategy into workable action plans. Moreover, banks, especially government-owned banks, need to embrace technology to offer better products. This will also help make banks more efficient. Thank you.